Hey, good morning, everyone. Thanks for joining. I think this week, this is the hot topic, right? We will go into the SVB or Silicon Valley banks. I'll just do a very quick recap and then we'll go to Slido to answer any questions that you guys have. So let's say in the mid of discussion, you have any questions, please drop at the Slido. I don't think there are many questions there. We can cover all of them. And let's get started. So I think before we hit the record button just now, I was having these conversations with A to talk about the Silicon Valley Bank and how's the capital structure or the balance sheet structure works. So this page, right, the screen sharing that I'm showing here, this is taken from All In Podcast. So they have a very lengthy discussion on these issues, and I highly recommend you guys go and watch if you want to understand the situation. But we'll touch on some of the points mentioned during the podcast. That one is a very long podcast. So to understand the balance sheet structure of a bank, right? So I think you just have to look at the balance sheet and just to understand what are the assets they own and what they have on their liabilities, which is what they owe. On the Silicon Valley Bank balance sheets, right, you need to understand how much asset they own and then how much liabilities that they owe. Okay, so what they own, right, is all these assets. So they have some cash, they have some assets on that's available for sale, and then they have some hold to maturity securities. I think these two, right, there are some treasuries there, they have some mortgage-backed securities and so on. And they also loan to their, they did some loan. I think they fund some of the startups. So this is on their loan book here. So this is their assets. On their liabilities, right, this is how much they owe to their depositors. So mainly it's customer deposits, and then they have some other debts. So now the problem that they have, right, is that if you want to understand how much equities, it's just you take their assets, this 208 minus their liabilities, 195. This is what we're talking about, like what, 13 billions dollars of equities on their balance sheet. This is the values to the shareholders. Okay, but the balance sheet size is still quite huge. It's like 200 billion plus asset and about 200 billion liabilities. So the balance sheet is quite big. If the assets, right, drop below the liabilities, essentially they are insolvent. Okay, so the equities value become negative. So that means they are insolvent. Now they have a combination of issues, right? Solvency is one, and then the other one is liquidity. Liquidity problem is when all these depositors, they sense that the banks have some problem, right? So what they do is they just draw their monies away. So all these customer deposits, right, it's just like the deposit that you have with your OCBC or DBS banks. You can draw your money anytime you like, right? So when all these depositors, they know that the banks have some problem, they quickly go and draw their money out. And this customer deposit will drop, right? And how the banks is going to pay this deposit or to fund all this withdrawal is they have to use the cash that they have, and then at the same time, they have to liquidate their assets to pay all this withdrawal. So to certain extent, when there's this run on the bank, right, they don't have money to pay out all this withdrawal. That means they are illiquid. So basically, that's bankruptcy already for a bank. Of course, before that happened, right, they can actually, like talk to the Fed and get some lending facility here and there. There's things that they can do, but when you look at the balance sheet and do an assessment, basically you will know that they are already insolvent. That's why the entire bank now already placed under the FDIC, what they call it receivership, meaning that the government already take control of the bank and they stop the withdrawal, and then they will do an assessment, and then they will have to liquidate whatever assets that they have. And then based on the money that they can get from the assets that they liquidate, right, they will then see how much they can pay to the depositors. So I think for every depositors, the how to say, the insured amount, right, the 250K, that one for sure they will get one, no problem. But the problem is, I think majority of their assets is actually exceed this 250K, because the problem now is that all these depositors, right, I don't think they are like, majority of them is like, individual people. If every one of them is like individual people, they all have like 250K in their deposit, I think this is not an issue. But the problem is that there are quite a number of startups, small, medium companies and so on. This is not like the amount is not like 250K, they could have like 1 million, 10 million, 100 millions, 500 millions with the banks. And for all these banks, if they are insured up to 250K, that's useless, right? Because they have like tens of millions with the bank. So what happens is that if they don't get the money back, so it can turn out to be a contagion problems, and then they might have to declare bankruptcy because they don't have money to pay their creditors. So I think in these situations, they have to resolve this very fast. We're talking about like have to be within a couple of days, either some other bigger banks that will acquire Silicon Valley banks, or with some mix of government fundings and so on, or government guarantee and so on. They have to make whole of all the depositors here. So I think that's the situation that they're facing, because if they don't cover these 173 billions of all the deposits, what happened is that, Silicon Valley banks, they are like top 20 banks. Below Silicon Valley banks, there are like, hundreds of banks. These are like small size, right? Like in total assets from 200 billions to like, tens of billions. So what happened to all these smaller banks? So there will be a run of the banks for like the weakest of all these banks, and there will be cascading effects, contagion effects, if they don't sort out, they don't protect the depositors on this. So I think this is something that they are working on. Probably within a couple of days, they will sort this out. And if not, it will be a problem. And just now we also talk about like how do we see, like A asked me, like when he looked at this JP Morgan, it seems that the share price still looks relatively safe. I think my explanation to this is that when all this like confidence hit the markets, right? I think the bigger one, like JP Morgan, Bank of America, Wells Fargo, these are the big four, right? So they will be fine, because no one will let all these largest bank like have any problems. So there will be this flight to safety effect, meaning that companies like all these small and big companies, right? If they sense that there's some problem with the banks that they are using, say for example their bank is the 50th or 70th largest bank, right, which is a small bank, they might just draw out the money and then put with JP Morgan or Bank of America and so on, right? So actually all these largest banks, they will benefit from this because of the flight to safety. So you can't see that. But if you look at this one is iShares US regional banks, right? These are the smaller banks. So you can see that their share price already reflected the loss of confidence, and hence just over the past, let's say 1 month, right, the price already dropped by 20%. This is like large drop given just just within 1 month period. And if you look at the holdings of these banks, right, you see that these are not like the largest banks, right? And just now we talked about like we can only recognize the US Bank Corp and PNC Financial. If you look at all the rest, right, these are all the small banks that like very small until like we can't recognize all these names, right? So I think that the problem is that now they have all these smaller banks, they will have a trouble if there's loss of confidence on the smaller banks. That's why I say that I think someone have to step in, like either US government or some larger bank. They have to like absorb Silicon Valley banks, and hence make sure that all this customer deposit, right, whoever like just place your deposit with the bank, you will get all your money back. I think that's very important, sir, because the problem is not about like how much value that you attribute to the liabilities or assets. The problem is on the confidence. And once the confidence is gone, right, it's very hard to build it back. That's why they have to make sure that they can sort this out within a couple of days now. And there are so many small companies that they are relying on the monies in Silicon Valley banks. If not, they can't even pay the salary of their workers. So all these have very big contagion effects. So I think that's the situation with Silicon Valley banks. Okay, I'll just put a stop here and just want to see, like, we can of course get into more details if you guys want. Just want to see you guys have any questions to kick off the session.
A question on Boon Tee. Can you hear?
Yes.
Yeah, but actually, if the case where I presume that the bank should knows that the customer will withdraw the money out soon, I think, in the startup. So if that's the case, why do they put so much in the? If I understand it's treasuries, if I understand correctly, they put inside the T-bills. So I thought that that's quite risky if they put so much of money back to T-bills. I thought they should have, some buffers for the next coming 1 to 2 years that the startup will withdraw the money. There's something puzzled. It seems to me that whatever amount people deposit, you just put inside the T-bills. So I thought that's not a very wise choice.
Mm. Actually, I don't know why all these like startups they put so much money in Silicon Valley banks. But you have to understand one thing is that we are talking about startup, but their size could be as small as like 3 or 5 workers until as big as like some of them having like hundreds or even thousands of workers. But it's just that they don't they haven't IPO. They're still at like the VC stage and so on. So we call them as a startup, but some of them could be quite big. Like they have revenues and so on, right? So for this, they have to have money in the banks in order for just to run their operations, meaning that they have a business, they have revenue come in, they have to pay their workers, they pay their creditors. You cannot like just put your money in the form of treasuries and use treasury to make the payment. So this is not how it works, right? Say for example, I have my money in treasuries, I can't use it like a cash. I still need to use the banking system to to let the money flows to make payment and so on. So some of them, when you look at their income statement, revenue and so on, right? It's not like they don't have revenue. It's like, for example, like Roku, they came up and say that they have money stuck in Silicon Valley banks and they're monitoring the situations. So Roku, if you look at their revenue and expenses and so on, it's not like they are like talking about hundreds of thousands. It's not like that. It's really the money is in millions, tens of millions, hundreds of millions. So basically, they are just using Silicon Valley banks as their bank to facilitate all this payment, taking money in and so on. So naturally, they will have some exposure in there. The question is like if they have extra, they don't need that much. Could they put their money in like treasuries? I think that technically, yes. It's just that their money with the deposit also, like for example, I also have like monies in bank, right? I wouldn't expect that bank will suddenly go and bankrupt or have this kind of problem, right? Yeah.
Actually, my question is, why did SIVB put all the monies in T-bills? I think that's the question. I mean,
why they put their money in T-bills?
Or am I wrong? This is my understanding. Actually, they put in T-bills and then they start. So all these smaller companies, when they want to withdraw money from this bank, then the bank cannot return them back so fast because this bank has put most of their monies inside the T-bills. I mean, I could be wrong. This is what I understood.
Okay, the problem is definitely not T-bills, because if the Silicon Valley banks they put their money in T-bills, and let's assume that the T-bills is in this category. Hold on, let me share the screen. So let's say if there are T-bills you are talking about, those in this available for sale securities, actually they can just sell the T-bills and take their money and go and pay the withdrawals. So it's not a problem for them, let's say if they put their monies in T-bill. So let me explain to you their problem. Why they have all this money is because during 2019, 2020, and maybe even 2021, there's a lot of all these deposits that flow into Silicon Valley banks. And once they have these deposits, right, which is on the left-hand side here, they have to put the money somewhere, right? So of course, they receive the money in deposits. Of course, the bank, they can put the money in T-bills. And let's say if there's withdrawal, they can easily sell their T-bills and then just pay the withdrawal. There's no problem with that. So naturally, if they put money in T-bills, there is very little risk. The problem is that the monies that they receive in deposit, they also pay interest on this deposit. I don't know how much interest that they are paying. Could be high, could be low, I don't know. But of course, on one hand, you need to pay the interest. On the other hand, is that you take the money, you have to put it somewhere to earn some yield. If not, how do you pay the interest, right? So you have a choice. Like you can put your money in T-bills and earn. Back then, right, we're talking about like 2020 or 2021 when the interest rate is still rock bottom. They can put that money in T-bills which earn nothing. And so how do you pay the interest on the deposit? Then, of course, you can say, let's put the money in, let's say like 3 years or 5 years or 10 years treasuries, which is still like, how to say, safe, because these are like guaranteed by the government. But you are taking a bit of like what we call the duration risk or asset liability risk. meaning that now your assets, right? Let's say you put money in 10-year bond, if you hold until maturity, for sure you will get back all the monies. But let's say if you not able to hold to maturity and you have to sell your assets halfway because your depositors are demanding the assets back, right? You have to sell your 10-year treasuries. And that one, how much price that you can sell at is really depending on the yield environment when you sell it, right? Say, for example, now, fast forward already 2 years, now the yield is already much higher. If they have to sell, you have to take the loss if the price is low, right? Because the 10-year yield already shot up, okay? So that is actually what happened, because I think just a few days ago, they announced that they're selling this available for sale portion. And then they lock in a loss of about around 10%, I recall. And that amount is about, like, I think $2 billion. So they recognize the loss immediately, just because this loss, right, is the difference between the price that they bought these treasuries and the price that they sold them. So there's a difference there. This is a loss that they record in their income statement immediately if they are forced to sell. So that one already happened. But let's say if all the money is in this category, and let's say if the loss is smaller than the equities that they have, right? They still don't have to go into insolvency, right? But the problem is, if you look at their situation now, is that there are huge withdrawal from the deposit. So you can see that, I think this also I pulled out from the All In podcast, and you can see that just within that one day, when people questioning about that, these banks may go under, right? So there's already 42 billions of deposit has been like pulled out from the banks. So you can see that this 173 billions, like 1/4 of the money is already pulled out immediately. And then they have to sell all the available cash here. But to certain extent, like all the liquid one will be gone, right? Like cash gone, all these available for sale, treasuries, whatever they can sell, already gone. But what's left is those that is like poorer quality. Say, for example, like mortgage-backed securities, that you cannot sell within a short period of time without like huge mark-to-market losses. And then all these loans, how can you sell? Like, so you cannot just suddenly you do your lending to all the startup. You cannot just now jump to the startup and say, hey, I want my money back, right? So there's some asset and liability mismatch that's happening here. And that's actually caused the problem for the banks. And if you look at their balance sheet, you know that they have problem. They can't fulfill all the obligations on the deposit side. That's why FDIC have to step in and just acquire the banks. And now they have to sort this out. It's basically an asset liability mismatch.
Okay, thanks.
Is there any other questions? Oh, for those who just joined a bit late, right? Just now I just do a very quick recap on the problem that Silicon Valley banks is facing. So like we went through some of the details here, but I don't think this is that difficult to understand. It's just an asset liability mismatch problem. And now FDIC already taken over the bank, and they just have to unwind the whole balance sheet and make sure that all the depositors will get their monies back. So let's say if you have any questions, you can put into Slido and we can get into that in more details. Before this week, did you read about any gurus talking about bank run already raised interest rates for quite some time? Someone should warn, or is gurus now mahu pao again? Okay, I think quite funny comment here. I think the situation is like this, right? All this bank run, right? It's not something that is so easy to predict. I will argue that it's very hard. Like, even if anyone predict that this will happen, right, they are just making guesses, because you need to understand the mechanics of a bank run. It is not like the deteriorations of the banks, right? It's like, okay, slowly 10% drops, 10% drop, 10% drop, now until 60%. So already cross a threshold that you think is a problem, and people saw it, and people just warn it again and again. So then now it become a situation, and it just collapsed, right? It's not like that one. So the mechanics of a bank run is that they are fine. Like, if just, let's say 1 month ago, if we look at Silicon Valley bank situation, right? And you ask me to make a guess, say whether this bank will go bankrupt in let's say 2 months' time, right? Likely, I can tell you I will tell you the bank is fine. If you look at the balance sheet and so on, they are actually fine. You can't spot the problem that easily. The reason is because they fail because the confidence is gone. That's the situation. So there's this threshold. Suddenly, someone just won. Say, for example, in this case, is I think Peter Thiel. He won his like all these holding companies and say that okay, there will be a situation. Let's pull your money out. And then what happened is that all these people who get a direction from Peter Thiel, and then they say, okay, I have no choice. My boss already hinted me, so I have to pull my money out. And what happened is I just shared it to my friend. And then someone heard of this and say, oh, there might be problem. People already withdrawing out. And then they will just withdraw out. So one leads to the other. And this is like a prisoner dilemma situation, right? Which is also mentioned in the All In podcast. You can go and listen the more like detailed explanations there. The problem is that, let's say if you have a bank, you have money in Silicon Valley Bank, the bank is okay just like 1 week ago. Now suddenly people are talking about like okay, people are withdrawing money. And you just want to make a decision for yourself, right? If you pull your money out, there's no penalty. Okay, you basically just some hustle that you have to pull your money out, and if you need to set up open a new bank account, you can just do it. But it's just some paperwork and so on. But there's no penalty. But let's say if someone who didn't act right and just hold and just wait a couple of days, and suddenly now your money is stuck there, right? It could be stuck for like a couple of days, it could be stuck for 2 weeks or 1 month, right? But your bank account suddenly just stuck. It's not a good experience, right? Basically, you are worrying whether you can get your money back. So there's like 100% penalty if you don't act, but there's zero penalty if you act. What happens is that everyone act like this, right? If you look back at their balance sheet, 173 billions. If they are fine and no confidence problems, this banking deposit will just continue to stay there. There's no problem, right? But when there's bank of the run, there's confidence is gone, money all out, right? Regardless of the structure on the asset side, even if they can double the assets, those like good quality assets. Say for example, instead of like 20 billions in treasury bills, they hold like let's say 30 billions or 40 billions treasury bills. When the bank runs happens, they still cannot don't have enough liquidity to pay. This is the problem with the banks. The problem is that even if the quality is like 2x better, once the confidence hit, right, bank on the run, like run on the bank, like all this happen, right, they will still go under. You get what I mean? So it's not like something that you can see it happening and then happen for some time, and then you can spot it before it happens, because it's very hard to spot when the confidence gone. It will just be like okay, they are doing fine, okay, there are some risks there, but usually should be fine one, and they are fine for can be very long time, can be 3, 5, 10 years operate like that. Even if you look at all those European banks, right, you can study Deutsche Bank, you can study all the Credit Suisse, right, they have all this problem, like their asset and liability problem for many, many years already. I would say in decades already, but they are still hanging around for like 3, 5, 10 years. If someone go and warn you, like, okay, Silicon Valley banks got some problem, but they started to warn you since like 2014 until now, right? Will you say that they make a right prediction? It's also no, right? So when it comes to bank, just because of the dynamic, it's because of all this confidence problem. I'll just argue that no one can predict it, because it will just go okay. Suddenly got problem already. It just like go down the cliff. So I would say don't bother to talk about like any guru able to predict all these things. Just because of the dynamic itself, right? It's like nobody can predict this. And anyone predict this, right? Like I can come out and say like all these smaller banks that we are looking at, right? You see the list that I'm showing here. Probably I can just point this first bank that might go under now. I can make a story, and then you can look at their balance sheet and so on. We can pick 1 or 2 or 3 points that they are weak, and then just make a story out of it. And likely is that they will just stay on okay for 3, 5 years, right? So then become like wrong predictions. So I would say maybe don't bother so much about the prediction part, like the warning part. When it comes to bank, you just need to accept that regardless of, okay, if they are well run, okay, they are of course much better. But when they are badly run or the management sucks, doesn't mean they will go under. They can hang on for some period of time and so on. So don't bother about this. I think this is a good questions, good to clarify on this. But I think you need to set the expectation right when it comes to, is there anything that we can see, or is there anything that actually no one can see? If no one can see, just accept that no one can see, and accept that. I think that's good enough. Silicon Valley Bank collapse news, thought on what companies or sectors to avoid any impact on Asia banks like DBS and HSBC. I think let's understand a little bit more on Silicon Valley banks, right? Because to be honest with you guys, right, before these things happen, if last week you asked me what is Silicon Valley banks, right, I'll just be honest with you, I have really never heard of this bank before. Like even the name sounds very, far. Like I never heard of this. I don't know about this bank at all. But after this happened, of course, I'm going to read up something about the bank, see what are so special about this bank, why they fail, and so on, right? So if you want to like understand Silicon Valley banks, they are like the largest bank on the West Coast. So this is what we call the regional banks. Regional banks means that they don't operate in the entire US. They only operate in like a certain region. And I think if you look at those smaller banks, right, like those rank from, let's say, 40 to 100, right, you notice that there are many banks that they really just specialize into certain region, or they specialize into certain niche, certain sector, and so on. So they are, there are case for these banks to exist because they can structure their operation to tailor-made for certain niche. So they can do stuff that maybe doesn't make sense for larger banks to do. Say, for example, this bank, they release tailor-made for the startups. Let's say all these startups, they have some special problem that only startup has, right? So, and they want a banks that really come up with solution that fit for their problems. It doesn't make sense for like Bank of America to do it, because if you look at Bank of America, how many percent of their customer are actually startups, right? Could be very small. But for some smaller banks like Silicon Valley banks, it could be like huge part of their customers are really all these startups. So if they have any requests that make sense for them to come up with a product that fit for all these startups, right, then they can create. That's why there's some how to say, some selling points or some reasons for them to exist. Okay, so that's why they're also quite good when it comes to these startup customers. They have the business there, right? But when it comes to like other traditional banks, say for example, could be JP Morgan, Bank of America, DBS, or HSBC, or any big banks, right? You will notice that their asset and liabilities are totally different compared to like the smaller banks. So in terms of their customers, so depositors, also those like very, how to say, boring one. Say all those uncles, they put their money in fixed deposit and so on. So if money on the deposits, fixed deposits for 1 year, they lock in you for 1 year. Actually, you still can pull out the money. It's just that once you pull out, there's some penalty. So if you pull out your money, let's say you have FD with DBS for 1 year and you just pull out, actually bank make more money because it's a penalty. They don't have to pay your interest for let's say you already put the money in there for 9 months, you pull out, actually they make more money, right? So they have a much better depositor base. They don't pull their money out like within short period of time. So this one is a strength to the companies, to their balance sheets, right? So this is one thing to watch out for, meaning that on their liabilities, it's not as shaky as Silicon Valley banks. Then on the other hand, you can look at their assets. What do they invest in? So I haven't really studied DBS or any of these big banks looking at their assets and try to understand their quality. But at least I would say that for these banks, right, maybe a huge part of their assets is really on all the mortgage and so on. So let's say if the mortgage, if the borrowers just default, you can just take over their properties and do a lelong on the properties and get a fractions of money back. And that fraction could be huge fractions, right? Could be 80, 90, 100% of the money backs. So this is what we call there's some collateral that they can get back the monies, right? So if you look at the banks, you look at their depositors are those like not those that can pull their money out anytime. And then you look at their assets, it's like, okay, they have like when they do their lendings, they don't simply loan the money out. They actually do the credit scoring well, make sure that the borrowers have good quality, good credit quality. And then even if something wrong with all these borrowers, they can still have collateral and so on. So there's multiple layer of like how to say guarantee or some reason for you to believe that actually asset and liability, they are well managed. So there's no reason to say that, okay, DBS will go under, you know. So if no reason for them to go under and the confidence continue to be there, depositor continue to be there, and this depositor is actually served as a source of like a cheap funding for these banks. Actually, it's a good business for the banks, right? So it's just that in terms of the management, they just need to do things that is like, responsible things, meaning that when they lend money out, they don't simply lend the money out. When they do credit quality check, they do a proper credit quality check. As long as they perform that, right, they can still like continue to run their business well and get good return and good business for a bank. So also, I don't think there's like huge impact to like the bigger banks, especially those well-managed ones. In fact, I would think that they will benefit from this, because the smaller banks, when people feel scared, they draw their money out. Where do they park their money? All these depositors, they're not going to park their money with crypto, you know. So they're going to put their money with the larger banks. So I think larger banks will actually benefit from this. Okay, so I think yeah, I would say not much impact, but for the smaller banks and for the like smaller bank that do stuff that is questionable, hard to say. And as of now, I would say very hard to predict which bank is going to fail. Hope that they will stop this contagion from cascading and cause other problems. That's on the other banks. Historically, in terms of contagion and bank default, what industries perform well? Actually, I will say there aren't that many, there aren't that many history to look at for this type of situations. The one that is recent enough is really after 2008 to 2009. So let's say if all this, right, let's put a scenario. Say Silicon Valley Bank collapse, and then like let's say another 20 all these regional smaller banks also collapse. Okay, say for example, like government didn't act fast enough, so there's problem, right? So when there's enough banks really collapse because of all this contagion effect, okay, to a certain extent, even the larger banks also will collapse, because like the domino effect, right? The small one drop, and then the larger one will drop, and then the larger one will drop, and so on. When this one become a big problem, then what happened is that the Fed cannot continue to raise rates anymore. So what happened is that, I mean, you just follow the sequence, right? So the Fed might just pause the rate high, and then maybe they will just continue to do the QE, restart the QE, drop the interest rate to zero, just to make sure that this domino effect will stop, right? And they want to make sure that for the remaining banks, because they are already so weak and their assets, maybe they're holding some treasuries, let's say like 10-year bonds, and now if they sell, they have to lock in losses, right? So what happened is that the Fed have to pump all those liquidity into the market, so that the 10-year yield drop to low enough, so that all these banks, if they liquidate, they can actually profit some gain instead of losses. So if that happen, right, so meaning that yield will be very low, all the growth assets will benefit from there, because they actually have some, all this business or startup or VC that will enjoy from a low interest rate, or they can enjoy big time from all this QE, they will benefit. So that's something that you can just look at how, like from 2011 to 2020, the low interest rate environment, which sector benefit the most, right? This will be like all the tech companies, big and small, they will benefit from this. So I think that's one thing to look at. But I will not say this should be our best estimate scenario, because all this contagion, it doesn't take a genius to understand this can become a contagion effect. So if I can understand it, I'm sure that US people in the US government, in Federal Reserve, they can understand this. So it's in their interest to stop this become a contagion, right? So I think what happened is that they will resolve this within like a couple of weeks and so on. So don't expect that this kind of situation, like for example, like the like Federal Reserve pause the rate high and then do a QE. Don't think that this is base scenario. In fact, I think that this is very unlikely scenario. I think they are able to stop this before it become a bigger problem. What is the impact on SIVB tech stocks? Impact other banks? Do most banks do the same as SIVB? Just now the first one I think I answered already. I think if there's an interest rate drop, of course, tech stocks, all these those companies that relying on cheap financing, they will benefit now. So I think this one I already answered. Impact to other banks, then the question is depending on which bank that we are talking about. Like just I mentioned, the larger bank, I think they will benefit, but the smaller one, it really is a question of the confidence. If the confidence really become like loss of confidence, then the smaller banks, those that are doing similar things like SVB, they will also be impacted. They will be run on the bank if someone don't step up and just stop this from this domino effect from continue. So the question is, what will the US government, what will the Fed do, right? I think this one is harder to guess because like just I mentioned that it is in their interest to step in. That's correct. But politically also, they also don't want to do too much if it is not necessary. Because there will be people who step in to say, the US government always do this bailout and so on. So politically, they will try to do as little as possible because they don't want to be seen as someone who go and bail out all the, like all the billionaires, like all the equities holders, shareholders, the so-called the rich. So there's some inertia there as well. But you need to see where the bailout is. If they are going to bail out the shareholders, I think this is a big problem. But now we are talking the depositors, right? So I think there is a different story. So that's something to understand. There's some difference there. Do most banks do the same as SIVB? I'll say SIVB is very special in the sense of they really cater for the startup and to the West Coast. But if you look at other smaller banks, I would say there are many different type of niches. So some are very niche in, let's say, like mortgage, commercial mortgage, or some other things. So they do different things. And there are, like hundreds of banks, right? So I also don't know what are they doing there. So it's very hard to guess like what's the problem that they're facing. But the type of problem, like the asset liability mismatch that I just mentioned, right? Like on asset side, what do they own? Do they own like a 10-year treasuries and backing depositors, which is short duration, right? The long short durations, or they do lending on some questionable creditors, questionable borrowers, right? All this problem, I will say other banks also have similar problems. It's just that we don't know to what extent, like if we talk about like they really lend out money to those who have questionable credit, right? How questionable it is, how bad it is. So this is like varied from bank to banks, and it's very hard to know before you really go deep down into their balance sheets, their 10Q, and look at to understand like their the quality of their books. It's very hard one. It's very how to say, very how to say, tedious work to do. So I'll recommend you watch the Big Short movie. You remember Big Short? Michael Burry, that guy. That there's one scene that he really go and download the entire all these mortgage-backed securities, look at line by line who are all these creditors and so on. You really need to do this kind of like detailed CSI to understand the quality, whether it's good or bad. If you just look at it from like a high level, just look at balance sheet, you don't know how good or how bad it is. So it's not that easy to understand these questions here. Whether are they the same or not. I would say now SIVB, since they already go under, then we can argue to say that, they are the, like the risky one. But I'm not surprised, let's say, if some other banks like also acting as risky as what SIVB do. I'm not surprised. I'm sure that there are, like there are other banks that is worse. Will they go under? That's who knows, right? Yeah. Because the run of the bank is very hard to predict. There's some psychology effect there. Let's go into this. Some in the Telegram chat like to talk a lot, give a lot of opinions. Sometimes listen to this kind is dangerous. Who should we be able to trust in the chat group? I think my answer to this is that sometimes in social medias like Telegram or like even Twitter or any other platforms, maybe don't pay too much attention to who is giving these opinions. Just have to understand the points. You just treat this as like anonymous making these points, what you can do is you don't trust the guy. Like let's say I myself, right? I say something, or any other people who say something. Maybe just don't trust because that's the person say something. Say for example, even Jerome Powell come out and say, oh, banking financial is safe. You don't trust that statement just because Jerome Powell make that statement, right? You don't type that statement and give it 100% trustable score just because it is that person who make that statement. You need to have your own independent judgment on whether the statement is right or not. Okay. So of course, someone say something, you can say, oh, okay, is that a good point? Maybe yes, right? Maybe you haven't thought about that. So in this situation, I would say social media, whether it's Twitter or Telegram, it is a good place for you to spark some ideas, to let you think about something. But whether it's right or wrong, you have to triangulate with other stuff that you understand, and just go into more details, like the first principle way of understanding things. So just go through that exercise and think in a clearer way, and then make the assessment yourself. So that, let's say if you get some insights from the group after you do your own assessment, and you have some insights and you want to act on that insights, right? You can just act on it, and if it screw up, you have to blame yourself because that's on your own insights, right? You cannot blame others because I bought into banks because Boon Tee say banks won't go under. You cannot blame it to other people's, right? So if you blame it to other people's, you will be forever looking for someone to trust and so on, which I will argue is not a good way to operate now, because if you behave like this forever, you just rely on someone else. Whereas let's say if you treat all these people's, right, could be myself, could be other people's, you can just treat that as someone to bounce ideas, and then we all tend to argue a lot, debate a lot in the groups, right? So you can just join the debate, argue, and then see whether you are able to convince someone or not. And if other people are not convinced, it just means that your points is not good enough. Then you have to go back to the basics and study again all the pointers, and try to make a more convincing arguments. Then everyone just do this kind of arguments. It actually help people to develop their financial literacy, right? So I think that's the way to go lah. Don't have this kind of oh, I trust him, I trust her, and so on. I think you have to trust yourself. I think that's the things, right? Don't skip that part lah. Don't be lazy lah. I think that's the thing I want to cover here. Agree. Empty vessel make most noise. Be very careful. Never see people like Boon Tee talk in the group. So likely quality of chat is low. I will be very, very how to say, respectfully disagree on this statement. Okay, I'll say that if you compare the group that we have versus other groups, right, you will notice that this is one of the groups that is, in terms of the signal to noise ratio, right, is one of the best one that I have seen. The best is because I'm not saying that there's no noise there. Of course, there's a lot of noise. It's just that the noise is not as many as other groups. Some other groups, right, if you look at their chats, right, it just keep flowing hundreds of messages per day. And if you look at that 100 messages, right, they aren't that many that can actually add values. Whereas our group, right, you look at it, is that there aren't that many people commenting. If you pay attention, every day, I would say the top 10 most active people, these are the same people again and again. So these people, we kind of already know each other quite well already. Like for example, YCX is there. We know that he's very bullish on Nvidia, and then he's bullish on Bitcoin, and he's bearish on certain things, right? So we know the personality, and we know their viewpoints. When we argue that time, we also know what are the points that we should keep on argue, and what are the points that we won't. We start argue already. We kind of accept that we just have different opinions, which is fine, right? But there's already some rapport among the top 10 most active peoples, and these peoples tend to be the one that have good viewpoints when it comes to certain topics. And let's say if you have questions, and you think that okay, I'm looking for something. I don't get how to say a convincing answer. my suggestion to you is that you can just, tag the person. Say, for example, I want to know what happened with Nvidia. You just tag YCX, or you have a company that you are looking at, which is considered like all those like deep value investing. You know that people like myself, Boon Tee, or YCX can't give you good answer. You can tag Boon Song and see whether he has seen the balance sheet before, and can get some feedback from him personally, right? So I think that if you tag to that person, you can get a very good quality answer. You tag myself, for sure I will jump up and answer you if you have any questions to ask. I think that's how we can, keep instead of like very open, you can be more targeted, ask the targeted questions. If required, ask the questions to the targeted person, and from there we can engage, any other people can also jump in and give their ideas and so on. So you will notice that this kind of discussion will be a lot more increase the signal basically, and instead of everyone just randomly talking about this and that, right? So that one will be a bit more contain more noises, I would say. Even myself also sometimes, I don't know, share stuff that's from Twitter and so on. If there's no discussion, it's all about all these link sharing and so on. Sometimes it could be quite noisy. I will agree on that. It's just that in terms of how detailed that we can discuss, someone have to ask the right questions. Then we will have good discussions there. The part of never see people like Boon Tee talk in the group, I think this part, those who are long enough in the group, they will know that actually, okay, I'll just share a bit here, is that I have another account that I use. So those who are long enough in the group, they know which account is that. So I'm still participating very actively in the group. So it's not like I just gone missing, right? So there's things to highlight there. Okay, that's on these questions. Some people can get 15 millions or Rolex. Most of us get nothing after 10 years. Life is not fair. Okay, how to go about these questions? I think good questions here, but I don't know how to answer that. Sometimes also, like I would say this is considered one of the tougher questions. Okay, one thing is that let's talk about the Rolex part now. Okay. Sometimes you look at people wear Rolex, right? I won't say that everyone who wear a Rolex is like, they want to show off. It's not like that. There are many people who truly deserve a Rolex, and even they spend money on Rolex, it doesn't hit their net worth so much. So these are people who have, like 7 digits net worth. A Rolex to them is not a problem. So these are rich people. But there are also like, many people who wear a Rolex because they have to wear a Rolex to show that they have money. But in fact, they don't have money. So, you have to distinguish between people who don't have the money because they spend the money away. But because they spend the money away to acquire all these people that you can see it, right? So you thought that they are very successful people. But actually, they spend the money away, so they don't have the money. And these people, they won't tell you they don't have money. So that's why I'll say there are many people belong to this category that they don't have money, they act like they have money. So don't be confused by that. And sometimes it's not so easy to differentiate, because on the surface they look rich, right? So you thought that they are rich. Actually, they are not. So there are categories like this, I can assure you. Okay. So don't look at the surface too much. I'll say that and don't look at others too much. You just need to look at yourself. Okay, that's the more important point that I want to make. Now the questions is like, okay, just like I mentioned, of course there are people who have 7-digit net worth, 8-digit net worth, and so on. They are rich people. Okay, there are poor people, but don't study the poor people, because I believe whoever who asked this question, or those who are young, right, like you haven't really acquired your net worth, right? So you kind of like think, oh, the world is not fair and so on. So it's like, but anyway, don't study those like those who haven't made their money. You study those who already like make their net worth. Say they are 7-8 digits, right? The question is, how can they be so rich? Okay, I think there are many books that you can read to study this point. But I would say that people who become rich Of course, I will exclude those who like Tio Toto and then they become rich, right? Just because they're lucky, or this one I will exclude because these are not the dependable way to acquire your wealth. I'll pay attention to those who do it on a systematic basis and then just acquire their wealth. I think two things I want to mention, right? The number one point is that you need to have a way to acquire money. Okay, this is what I will consider as like an active way to get money. Active could be, like you have your business, that's one, or you can just work, right? I mean, you work for someone else, you are an employee, but you can still get rich, right? Or these are the people who have like somewhat higher income. And the only way that you can deserve a higher salary, higher income is because you are able to provide the value. The question is, what kind of value that you can provide to others? Okay. So either you can like serve many people, and from all these like many people, you have a way to extract some value from it, or you can serve a small group of people, but somehow this small group of people, they are able to pay you good money. Okay, roughly these are two ways. The first one, I will argue, these are people who like become a YouTuber and then they make a very entertaining YouTube videos. Okay, of course, this exclude me. My YouTube, not many people watch. So when they are able to create videos that millions of people watching, they just extract like 10 cents for everyone that watch that videos through all this advertisement and so on. They also become very rich, right? So they serve like broad, like big group of people. This is one. The second one that I mentioned is that you serve, although you serve very small group of people, like you only have one boss, but your boss is very rich. Your boss is like a big company or a big billionaire, and he really need your specialized knowledge or specialized work. Say, for example, you are a lawyer, right? You say, okay, I serve my client. My client is like rich client, and the value that I can provide, like just one advice from me, I can save him like 20 millions. So he's happy to pay me like 3-5 millions a year for me to serve him, right? So this is like the value exchange that you can have with someone, and with that value exchange, you become rich. Okay. So this is the active part. Whether you work as a business owner or you work as a salary worker, doesn't matter. But what matters is that first you must have some value to deliver to someone, and you extract certain value from that someone. So this is the active part. Now come to the second step, which is the passive part. This is where the investment come from. Whether you can save like 10,000 a year, 100,000 a year, doesn't matter. But once you have this saving, or of course, saving has to be there after you deduct the expenses that you have. You must have the excess saving. So this is where the spending, the expenses part. You need to control expenses. You draw your value. You get your income. After deduct the expenses, you have the net saving. Put the net saving to the investment. The passive part will come in. And this is where I will cover, right, which is all the investment topics that we talked about in the past, whether you want to do passive investment, active investment, stock pick, funds, bond, equity, real estate, whatever that you talk about, all this group into the investment part, which is supposed to be more like passive. Like even if you do stock pick, you own a company, say for example, you buy Apple stock. Basically, you don't do anything, right? It's not active. It is active in a way that if you do your security selection, you need to study some financials to make your judgment on which company to invest. That's a little bit of active there, but it shouldn't take up like 30 hours a week, right? So if it take 30 hours a week, that's become like an active job already. So this is the investment part, which is the more passive part. And this part, right? You are not supposed to earn like 50% a year. It's supposed to be something like, okay, if you risk averse, you put into like treasuries, some combinations of FD, bank deposit, and so on, and some equities. The range is between, let's say, 5% to like 10 to 15% if you are very depending on your risk level. And whether it's like 5 to 15%, let's say just take 8% as a for discussion. That 8% isn't that big, because even if you have $100,000, you earn 8% is only 8,000 per year. 8,000 per year is nothing in terms of building your 1 million or 2 million. It's nothing. But the magic of this passive part is the compounding part, because whatever monies that you earn, you put it back and recompound again and compound again. And that's where the magic and your net worth will go up like exponential manner. And most of those money will come in like, like the later years. It's not in the first 10 years after you start working. So the magic will come later. You just need to be patient enough to continue to have the active income, like spend in a responsible manner, have that excess saving, and take the excess saving and then just invest prudently and just be systematic on how you do your investment. And that's it. 1 million, I would just say it's a matter of time. But if you don't sort out the first part, right, if either you don't have a high salary, say for example, your income every month you only earn, let's say 2,000. 2,000, if you are like just graduated or just started working, no experience and so on, and that 2,000 will grow over time, that one is still fine. But let's say if you are like already working for 5 years, because and you get a low salary because the value that you provide isn't the one that I mentioned, right? Like you don't provide high value. What you can do is you need to learn how to do that. You need to know how to provide like value. And that you have to go through the learning process. You can use ChatGPT and do some learning and so on. There are so many ways, right? But one thing is you need to learn how to have something of value that you can sell to someone else. That's the first part. Second part is the spending part. Like spend, don't like you earn 20,000 a year and spend 20,000 a year, you left with zero. How do you compound, right? So this is the second part. And the third part is investment. Because if you can earn and you can spend very little money and have high excess saving, and you pour your money into a bad investment, and you do a proper asset allocations, you don't do a proper diversifications, you pour your money into one single investment, that is single investment just gone case, then you still got nothing, right? So all these three parts, right, you cannot like skip, and all these three are important. Then the remaining is just like the discipline, not just do it systematically, then you will get there, right? The last sentence, like life is not fair, I would agree with you. After I talk so much about this, I'm not telling you the life is fair, because everyone's starting out with different level of IQ, different strength and weaknesses, and so on. So life is never fair. And we shouldn't expect, right? Everyone should have the same level of net worth. You shouldn't expect that. Everyone, like the net worth that you and I and everyone else, right? That there will be like a distribution. You don't need to care so much about what's the median of that distribution or what's the average. You just need to care about like where are you sitting on that spectrum. Okay. Let's say there's income inequality. Is there a problem if your income is like on the above average? You don't need to be like in the top 1%, right? You just need to be like in the top quarter. Then you are fine, right? So I would just like make that point. We all learn how to create all this active income, learn how to spend responsibly, how to know how to invest, is to put ourselves in a better position compared to the others. And even if the world is not fair, but our situation is better than the others, then that's good enough, right? You have a good life, that's enough. I'm not talking so much about the moral things now, because every one of us, we need to take care of ourselves. That's the first step. Take care of yourself, take care of your family. Whether life is fair or not, whether income inequality is a problem or not, that one, I would say, maybe let politicians to sort that out. And it's not you and me that able to solve this. So, and lastly, maybe don't complain so much because everyone have to work their things, right? So you have to work on the stuff that you are working on. Look for how you can provide more value to others, and then learn how to extract that value. Because you keep on giving value, don't extract back, also is a problem. So do all this, then you are fine. Okay. I'll stop the recording first, and then we see anyone want to discuss anything off record now. Okay. Okay. Thank you. Bye bye.